The extinction of the bear continues. The S&P 500 notched its 30th new all-time high in 2024, and just when things looked like they were going to turn in favor of the bears, with market breadth deteriorating and a slightly more hawkish than expected Fed, the market says not today. With the market rallying across all sectors and sizes, it simply was another win for the bulls. But with the market now looking extended on technicals and even diverging from fundamentals, we have to ask the question, when will the bears have their day? Today, we answer that question and also talk about where Goldman sees the S&P 500 at the end of the year. We all know that 5,600 is their baseline, but we need to talk about their bull case and their bear case. We'll also be talking about where we want to be positioned when the Fed does cut rates, why it's the Fed's desire to cut rates, and what happens if they don't. Will things fall apart, or will the economy continue to remain strong? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500. Very interesting day, risk on everywhere, and we saw this. Look at these defensive sectors: real estate, parts of healthcare plans. That's the real defensive side of healthcare, right? Look at utilities, very risk off. We didn't see the same price action here in staples, and there's a reason for that. We have a lot of high quality companies here and growth stocks as well. Stuff like Costco, right? Target, Walmart, Coca-Cola, Pepsi. A lot of people have these in their portfolios. Also stuff like Monster. So on risk on days, these stocks tend to rally as well. While there are also staple companies, they tend to do well in risk on environments, and that actually boosted the overall defensive sector. But we also saw peak outperformance here in consumer cyclicals, led by Tesla, 5.3%. I think that was coming off the back of some of the comments made by Cathie Wood, Tesla's vote as well. So, Tesla moving despite being diluted by 9%. But we also saw the bigger names in each sector move quite a lot. GE here in industrials, Eli Lilly in healthcare plans, Visa, MasterCard in financial services, and Apple here in technology. Still the biggest stock in the world, and definitely outperformed all of the mega cap names except for Tesla. And what we're also seeing is a bit of a rotation. We're seeing underperformance here in Meta, Google, as well as Microsoft, and we're seeing outperformance here in Apple. So you could be seeing a little bit of a rotation, even though it is still positive into Apple. And that's actually what we're seeing here in semiconductors. We're seeing a move out of Nvidia. It's red for the second day in a row. And we're moving into stuff like AVGO, Qualcomm, MU. And to see this broadening out in semiconductors is actually very healthy. It's been an Nvidia-led rally with semis following. Now it's the rest of semis leading and Nvidia following. That's really good, really healthy. And it's not to say that Nvidia can't perform very well. It's done very well in the last month. Just a bit of a broadening out. Very good. But other than that, it was a very green day across the board. The S&P 500 up 0.77%, all sectors included. Discretionary, infotech, and industrials were the leaders here, up 1.43, 1.18, and 1% for the day. Very strong performance, followed by consumer staples and financials, right? And when you have stuff like energy, com services, materials, financial staples, industrials, all in the green, you're gonna see a really vicious day in the market. And that's exactly what we saw. And I think a lot of the price action we're seeing also has to do with Powell's comments, the market coming to terms with the fact that even though he came off slightly more hawkish than the market was expecting last week, it still was overall dovish for the market. The prevailing long-term sentiment was still dovish. Rate hikes are off the table. Cuts are definitely coming, if not September, November, or December, and the market is positioning for that. We saw a rotation out of defensives, healthcare, real estate, utilities, and into risk-on sectors, discretionary, info technology, the peak risk-on sector here in the S&P 500. And on the back of all of this, market breadth improved drastically. The RSP was up 0.73% on the back of the S&P 500 up 0.77% and the Nasdaq 100 up 1.24%. Look at this daily chart here of the Nasdaq. We had a pullback to this 18,000 level, and it looks like 20,000 close is due for tomorrow. But we saw a broadening out in all sizes. The IWM up 0.84% here for the day. Midcaps gained, the SP 600 gained, on the back of bonds across the curve rising. The 10-year yield was up 1.37% for the day. The 30-year yield was up 1.29% for the day. And as a result, TLT long-term treasuries was actually down about a full percentage point here today, as well as down a little bit here in the after hours, as you can see. However, this is something we talked about in the live stream. We said a pullback to this level, and then we will continue the move up to the $100 level. The dollar was very firm last week, and we actually saw a red candle here down 0.18%. We're going to see if that momentum continues to the down downside. That's definitely going to be a positive for overall stocks. Looking at risk sectors, Bitcoin, strong rejection here off the lows, flat for the day, but a huge move from the 65,000 mark all the way to as high as 67,000 at the peak. Gold down 0.71% on the day. Silver red on the day, but well off the lows. I got into silver near the $29 level yesterday, looking for a move to $60, very small position. And then crude oil continues to move higher, and this is in the face of Biden actually selling quite a lot of the SPR. But let's actually dive into the S&P 500. Now, before we dive into the S&P 500, let's actually look at the gamma tape. Very interesting. Now, the gamma flip is at 5,500, and I think that's what we're doing. We're literally buying dips, selling rips to the 5,500. I mean, just look at the price action in the S&P 500 over the last couple of days. Literally buy dips, sell rips with a lean to the bullish side. And the gamma flip zone is now at 53.55, this red line right here. So plenty of support below, and then the put support is now at 5,200. In last week's video, I said we saw gamma compressing with regards to the core resistance, the gamma flip zone, as well as the put support zone. And I said normally that leads to a huge move to the upside. That's exactly what we're seeing. And I still remain contingent on the fact that we're going to be buying dips, selling rips to the 5,500 area. Now, there's very limited upside here. You're probably looking at about 20 to 30 points before we get to that level, but that's where we'll find solid resistance. So we probably go there. Did we actually hit that today? We hit 54.91, pretty much right on the dot, and then we saw sellers come in a big way here at the top. And if we actually dive into the 5-minute chart, this is where we opened a little bit of a gap down, and then we actually just moved. Look, higher highs, higher lows, to all-time high in the S&P 500. Yeah, we did come off a little bit, but I think that has to just do with 0 DTE hedges. And the daily chart, very, very bullish. Look at this chart. That is a new all-time daily closing high in the context of a new all-time weekly high last week in the S&P 500. And also same here for the Nasdaq. Very, very bullish candle. This looks insanely bullish despite some of the breadth dynamics we've seen. Even though we are seeing breadth move down while the S&P 500 moves viciously up, we could see that change ever so slightly. We did see flat movement here in stocks advancing versus declining. And if we could see a move up for the rest of the week above these highs, that would be very, very positive. But we look at this and, you know, it's the exact same thing we've been saying all week. We want to be buyers of dips, sellers of rips. If we do pull back, the main zone is 53.55, but ideally, I mean, you want to look here at the 54.50 and looking to the 5,500 area, but you should already be positioned. I was screaming absolute buy here at the 5,200 level. I was screaming buy here at the 5,000 level, and look at where we are right now. We probably do go to 5,500. Maybe we go retest these highs tomorrow, have a bit of price discovery there, hit the 5,500 level, but it should offer pretty strong resistance into this OPEX period. And once we have a lot of that gamma roll off, then the index can just be free to move the way it wants. But as of right now, dealers are hedging by buying into dips, selling into rips. Their lean is bullish, and you don't want to fight the trend until at least next week, until after June OPEX. That's probably only when you can look for like substantial downside in the market. Until then, buy dips, sell rips. Now let's talk about sentiment. This is BOFA's bull bear indicator. This is Goldman Sachs sentiment indicator, and these two indicators are diverging from what CNN's fear and greed index is telling us. BOFA's bull bear indicator rose to 6 from the 5.9 level, and 4 weeks ago it was here at the 5. So things are definitely moving towards the extreme bullish side. This would be bullish, but things are not crazily bullish right now. Still at the 6 level, definitely moving in the bullish direction. At the same time, Goldman Sachs sentiment indicator here is still above stretch positioning. We did move downward on a week-to-week basis, but still in stretch positioning, still at 1.2. And pretty much both these indicators, like I pretty much say every single week, is still telling us to hold the equities we have. There's still gas left in the tank, and I would really only consider selling a lot of your positions when we do get into the 7 region here in the BOFA bull bear indicator and above. Second we get above there, that's when you can really start to take a lot of your capital off the table, put in a money market fund, just collect the 4% and let the market do its thing on the pullback. This indicator is extremely reliable in terms of picking tops and bottoms, and that's when I would really look to selling when we get to the 7 range right here and above, into the 8, maybe even into the 9. But it's very rare that we actually get here. Normally the 8 area tends to be the top. And again, I reiterate, what both these indicators are telling us is to hold the positions we have right now. There's still gas left in the tank, but you want to sit through the volatility because breadth is extremely narrow right now. I know it says that below 5 is narrow breadth, but this right here being at 14, this is very narrow breadth, and the entire movement of the market is dependent on a few small names. And when you have a very narrow market breadth, if they do go down, you can see a lot of volatility. So in times when we have very narrow market breadth, you actually want to stomach the volatility and just sit through it all, because the market is being moved moved by a few very large market cap names. And you know exactly which names I am talking about: Microsoft, Nvidia, Amazon, Google, Meta. This is S&P 500 EPS revisions for the Magnificent Five, excluding Tesla and Apple, the S&P 500 as a whole, and the 495, so the S&P 500 excluding these 5 names right here. And it's very, very interesting. Since June 2023, you can see that index EPS was roughly at 100. This is indexed to 100. And in that time, we've seen a 38% increase in these 5 names, mostly driven by Nvidia. The S&P 500 as a whole has actually remained flat, excluding the Magnificent Five. We've actually seen the 495 S&P 500 fall 5% since June 2023. This is why the mega caps have outperformed, because earnings revisions have simply outperformed. And do expect this momentum to continue until we actually get a broadening out of earnings. And that is expected to occur here in the second, third, and fourth quarter of 2024. Now let's talk a bit about valuation. This is S&P 500 forward PE multiple for the market cap weight as well as equal weight S&P 500. And you can see the valuation discrepancy. The market cap weight is at 21 times. The equal weight trades at a 16 times. But what exactly does this mean for forward returns here for the S&P 500? Goldman have actually gone ahead and given us a couple of scenarios. Now, the first scenario is actually Goldman's baseline scenario. They have a price target here of 5,600, and Goldman actually recently increased their price target of the S&P 500, and they released this table with that price target increase. They said some very interesting stuff. So they believe that at the end of year, the S&P 500 can trade at 5,600, and that would mean the market cap weighted, the cap weighted index trades at a 20 times PE, and the equal weight right here trades at a 15 times PE. Now, what's really interesting about this is where we are right now. The S&P 500 currently trades at a 21 times PE at 5,400. The equal weight trades at a 16 times PE. In other words, what Goldman is pretty much saying is that on better earnings, multiples should compress, but the index should actually go higher into the end of the year. So as the S&P 500 rallies to the 5,600 mark, it actually gets cheaper. Now, they have a couple of other scenarios. They have a recession risk scenario where the S&P 500 multiple contracts for both the cap weight to 18 times, the equal weight to 14 times. That would put the end of year S&P 500 at 4,800. They have a catch down trade where the market cap weight index actually trades down to 17 PE. The equal weight stays at 15 as per the baseline, and that would mean the S&P 500 at 4,700. They have a catch up trade when equal weight actually catches up, trades at an 18 times. The cap weight trades at 22 times. That would mean end of year targets for the S&P 500 is at 5,900. Crazy. And then they have the mega cap exceptionalism trade, and this is the full bullish scenario. 23 times for the cap weighted, 16 times for the equal weight. End of year price target 6,300. Now, both his baseline target as well as the mega cap exceptionalism target is actually also dependent on rate cuts. Goldman expect the FOMC to deliver its first rate cut in the fourth quarter of 2024. So they see probably the November timeline, and then cut 25 basis points per quarter to an equilibrium rate to 3.5 to 3.75. That would be Fed funds. So this is when Goldman expect them to have their first cut, and then 25 basis points worth of cuts every single quarter into 2026. So pretty much 3 to 4 cuts every single year. And then this is their equilibrium rate. If we do get this, which would mean the first cut either to come in November or December, we can then see the baseline target of 5,600, and then maybe some of the higher market cap exceptionalism or the catch up trades at 5,900 and 6,300. But their baseline is 5,600, and I think that's a fairly reasonable target and not unreasonable when you think about it. Now, I do have some further data right here. This is S&P 500 sector performance 6 months after the first rate cut. Very interesting data. Do take it with a tiny bit grain of salt. This only includes 4 cutting cycles. It includes the 4 most recent rate cut cycles here in 2019, 2007, 2001, 1995. And we could see that in every single scenario, utilities was the best performing sector. Average return 6 months after the first rate cut, 5.2%. In second place, staples, 4.2%. In third place, healthcare, 3.6%. So definitely defensive sectors tend to lead after the first rate cut. Maybe that's because a lot of these situations have been very dire economic scenarios. 2019 COVID, 2007 GFC, tech bubble bubble bursting 01, and then in 1995 because the Fed thought the economy was softening. The worst performing sectors here actually tend to be technology. We're going to remove real estate because real estate only has 2 cases. So take real estate out of the equation. Technology was the worst performing sector, average return 6.2%, but if you actually have a look at the 2019 return, 9.3%, and it was the best returning sector in this time period. Discretionary here, negative 2.1% average return, 1.7% here for financials. And then comm services as well as energy tend to be fairly neutral into the first 6 months of rate cut. So if you guys are in the bearish camp, you do think the economy is going to soften significantly despite rate cuts, despite everything we're seeing, then you probably do want to be in utilities, staples, and healthcare, especially if we do get the first rate cut anywhere in September, November, December. Now the Fed without question has the desire to cut rates, and after last week's data, I think that's all but assured. And the 5-year break-evens tells you everything you need to know. For those of you that don't know, the break-even rate is just the measure of expected inflation derived from the 5-year treasury yield. And essentially we could see right here, we've had a huge move down in inflation and actually a capitulation move on the back of the CPI and PPI data. But as inflation falls, real rates actually rise. And this right here is part of the big reason as to why the Fed wants to cut rates. Real rates are the highest they've been since 2007 after 2022's all-time lows. For those of you that don't know what real rates are, it's very, very simple. Let's say you take out a loan at 5% and inflation is 2%. Even though you are paying a 5% interest rate on that debt, because inflation is 2%, the real interest rate on that debt is actually just 3%. It's your interest rate minus the rate of inflation. So the real interest on that debt is 3%. If rates stay exactly where they are right now at 5.25% and we are seeing clear disinflation trends, we saw the CPI data came in very, very cool. Real rates rise, which means the cost of debt is actually increasing. And this is going to eventually put a strain on the economy. And we already know it's putting a strain on Main Street, small caps, and some mid-cap stocks. And so part of the reason why the Fed actually want to cut rates is to actually normalize the policy. They want to normalize the cost of real rates as well as uninvert the yield curve. The yield curve has been inverted for a very long time, one of the longest inversions here in history. This right here is the 10-year and 3-month spread. Part of the reason why the Fed actually want to cut rates is to actually normalize the yield curve. And as a result, this fixes all the issues that come with an inverted yield curve, and it also allows for real rates to come down. And the Fed actually cutting rates to normalize policy is actually a really good thing. This right here is S&P 500 returns after the first Fed rate cut. This line right here is when the Fed cuts rates. Normally when the economy actually enters a recession after rate cuts, stocks tend to fall, and that's because rate cuts are done to support softer economic conditions. And because of that, 12 months later we can see returns upward of negative 15%. But if cutting rates are done to normalize policy and no recession is to ensue, and I don't think we're going to get a recession, if that is the case, the S&P 500 normally rallies. 12 months later we could see returns up to 10%. And what rate cuts do in that type of a scenario is just add more fuel to the fire. Now guys, let's talk about seasonality and likely outcomes for the S&P 500. So this right here is typical S&P 500 performance from June 19th to July 23. So this will only trigger on Wednesday. Pretty much the returns for the next month when the trailing quarter March 19th to June 19th is positive. As of the 15th of June, the S&P 500 has returned 4.89%, and unless the index absolutely tanks, this is likely to trigger. Now these are the returns we can expect. This is the next week of trade, the next 5 trading days, and then this right here is the next month of trade. So normally when the trailing quarter March 19th to June 19th is positive, this period here June 19th to June 27th is actually negative, very negative actually, negative 0.58% average return, 8 up years, 21 down years, and we have quite a lot of data, definitely statistically significant. However, we should just look at the next week if we do get downside as a potential dip buying opportunity, because the next month after that week from the 27th of June to the 23rd of July tends to be very, very positive. 25 wins, 4 losses, 1.84% average return, 2.60% median return. So if we do get sell side within the next week, week and a half, it should just be looked at as a dip buying opportunity, and we should take advantage of what normally is fairly positive returns throughout the end of June into July. Now data in the week ahead, guys, very interesting. We have a very light week of data, but the focus is retail sales, industrial production, and housing data. The big one is just going to be building permits and housing starts here on the 20th. Other than that, we have no major macro releases, and that's not necessarily a bad thing. You can see here that uneventful macro weeks are normally the best weeks for stocks. When there is zero key macro releases, the S&P 500 normally has the best weeks, returning 0.62%. So in weeks where we have very light data, that is a good thing, and you should just ride the momentum. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.